Picture this. You finally made it to retirement after saving, investing, and working hard to build your nest egg your entire life. But there's one key overlooked decision, which is when and where to pull your money from, which can end up costing you a fortune in taxes. And here at Blueprint, we've helped many Canadians build financial plans to master this exact decision to keep more of their money, sometimes resulting in tens or even hundreds of thousands of dollars saved. And in this video, I'm going to show you the smart withdrawal order most Canadians should follow, but also the key exceptions to this order. But before we dive into the order, let's take a quick snapshot together of your financial landscape. Think of this as your personal retirement dashboard. Number one is your goals. What is your mission? Are you planning to spend every last dollar enjoying your retirement as much as possible, or do you dream of leaving a legacy for your family? This really defines your entire strategy. Two is assets. Add up everything in your TFSA, RSP, non-registered accounts, and any things like corporate savings if you have a business, because the mix of these accounts will determine your flexibility. Third is your income sources. List out all your income streams like your CPP, OAS, company pensions, annuities, or rental income, because these will really be your financial pillars, which is the income you have before you even need to touch your savings. Fourth is to understand your tax bracket. Now, this is a big one. Your tax bracket decides how much of each dollar you actually get to keep. Here's what the 2025 combined federal and Ontario tax brackets look like. Note that these rates are for Ontario, but every province will have slightly different thresholds and rates, so make sure to look up yours. Most middle-income retirees aim to stay in that 20 to 30% combined range for their tax bracket. It'll become clear why your tax bracket matters so much once we walk through examples of how these different withdrawal orders affect your lifetime taxes later on. All right, let's get into the order. First is taxable or your non-registered accounts. So why start here? Well, these investments are the most exposed to annual taxation. Even when you're not selling, income from interest or dividends can still trigger a tax bill. Now, this tax drag slows down long-term growth. By drawing from this account first, you're spending the money that's constantly losing a piece of its return to taxes. And a big part of that is managing capital gains. So for capital gains exposure, check your non-registered investments for large unrealized gains. Find out what the adjusted cost basis is, which is the original price you paid for it, and compare it to its value today. That will be your capital gains exposure. And managing when and how you realize those gains is a big part of keeping your taxes efficient. You might want to look at implementing strategies like realizing some capital gains in lower income years, or maybe before the age of 65 to avoid those OAS clawback issues. Because though only half of your gains is taxable, it still raises your net income significantly. So meet Jerry and Evelyn, who are 63 and retired, and they have $300,000 in a non-registered portfolio, and they're doing some budgeting for this year, and they realize they're going to be spending some extra money. But instead of tapping into the RRSPs, they'll realize $15,000 in capital gains this year by selling off some non-registered investments while they're still in this lower tax bracket. And once they turn 65 and begin OAS, they'll decide to pause these large sales to avoid the clawback. So when this might not fit, it might make sense to hold off if your non-registered accounts serves as, say, a cash reserve or emergency fund reserve. There's also some scenarios where you might want to melt down your RRSP first as well, which I'll get into more in the next section here. The next is to draw from your tax-deferred accounts, which are your RSPs, RIFs, LIRA, FHSA, and more. So why draw from these next? Well, once you've used your taxable money strategically, the next step is usually your tax-deferred accounts. Note that I included FHSA in this list because it basically turns into an RSP if you don't use it to buy a home. In this category, every dollar withdrawn is fully taxable, but you have quite a lot of flexibility in when and how much to take. And that timing can make a big difference over your lifetime. The key is balancing lower taxes now with smaller forced withdrawals later on. The thing to keep in mind here is control, because you do in a lot of ways get to decide how much taxable income to create each year using these accounts, instead of letting, say, the CRA decide at the age of 72 once you have to convert your RSP to a RIF. Now, here's how to do it. I like to use what's called a bracket filling strategy. You can withdraw enough to reach the top of your current tax bracket without spilling into the next one. Now think of it like filling a glass right to the rim without it overflowing. And that's why it's so crucial to understand how close you are to your next tax bracket and if you really want to go through the extra effort to manage these brackets. Because for most retirees, that sweet spot is within, as I said, that 20 to 30% combined tax range. And also consider partially converting your RSP to a RIF around the age of 65, even if you don't need that income yet, because this allows pension splitting and the pension income credit, which could help to lower your overall household taxes. But be sure to coordinate your RSP or RIF withdrawals with other income sources, because if you expect, say, a large capital gain or something like a business sale that will accrue a lot of taxes, you might want to pause withdrawals and rely on something like your TFSA instead to stay in a lower tax bracket. And make sure to check your province's LIRA unlocking rules, as many allow partial access after 50 or 55. So meet Sophie, who's 62, retired, and has $400,000 in her RSP, $50,000 in her non-registered savings, and a small TFSA. She decides to start withdrawing $25,000 a year now, keeping her in roughly a 20% tax bracket. One year, she decides to trigger a large capital gain from her non-registered portfolio, and by doing so, she decides to lower her RSP withdrawals in order to keep her cash flow steady and to manage those tax brackets because she doesn't want to pay too much in taxes. So when this might not fit. So one example is if you're near GIS eligibility, early RSP withdrawals can reduce benefits. It can also backfire in high income years, like when selling a property or a business, since adding RSP income can trigger higher taxes or OAS clawback. There's also the estate planning angle that you have to be aware of. Now, RSPs and RIFs are fully taxable at death unless transferred to a spouse, which can leave a huge tax bill for your beneficiaries. And going back to how the order might be switched, if legacy planning matters to you, you might want to consider gradual withdrawals from your RSP even before, say, your non-registered accounts, and using some after-tax funds for, say, a permanent life insurance policy, because you'll turn those taxable dollars into tax-free proceeds for your beneficiaries. Because what a lot of people don't know is that insurance death benefits transfer to the beneficiary completely tax-free, which makes it an excellent estate planning tool. But this is exactly the kind of planning that we take hours to fine-tune with our clients using our professional financial software. So if you're looking for a customized withdrawal strategy that aligns with your income, taxes, and goals, our CFP and retirement specialist here at Blueprint Financial can help. So book your free discovery call at blueprintfinancial.ca to build the retirement you want with the right blueprint. Next up is your pensions, your CPP, and your OAS, and why these matter. So I debated even including your CPP and OAS in this video since they aren't accounts you can technically withdraw from, but when you start them is one of the most important retirement choices you'll make. And the timing that you decide to take these pensions affects not just your guaranteed income for life, but also how you should draw from your RSPs and TFSAs. So that's why I decided to include it. And coordinating these together can dramatically change your after-tax income. Many Canadians overlook this, but if you're watching, you're probably already ahead of most. Consider delaying. So for most retirees, delaying CPP and OAS as long as possible makes the most sense because your CPP grows by 0.7% per month after 65, which is up to 42% more at 70, and the OAS by 36% more by the age 70. It's a very simple, low-risk way to raise your guaranteed inflation-protected income. And I've seen this decision transform retirements on a mental level as well. Many clients have told us that delaying CPP was the best move they ever made. Not just for the money, but also for the peace of mind. For example, meet Kathy and John, who decide to delay their CPP and OAS payments until 70, while drawing from other sources like their RSPs. The result is about 40% higher lifetime guaranteed income and far more peace of mind during volatile market swings. They worry far less about their investments lasting the rest of their lives because of this decision. So when not to delay. So if your health is poor or your savings are tight, starting earlier might make sense. Also, carefully consider survivor benefits. For example, if one spouse has a higher CPP or there's a large age gap, starting earlier might help protect the surviving partner. So that's something that will take a bit more time to look at. Now is your tax-free account, which is your TFSA, and why it's often last. Well, your TFSA is one of the most powerful tools in retirement. Withdrawals are completely tax-free and don't affect income-tested benefits like OAS or GIS, which is why most retirees save it for last. Again, now how to use it. So let your TFSA grow while using other accounts for income. In years where you're earning high income, you might want to use it to fill the gap and keeps taxes steady. It's also the best place for high growth investments generally, since gains are never taxed. And if your RSP is large, consider withdrawing gradually and recontributing the after-tax amount to your TFSA if you have room there, because you're basically converting taxable dollars into future tax-free income. So meet Helen, who's 65, has savings across her RIF, non-registered account, and a $140,000 TFSA. Instead of using her TFSA early, she draws from her RIF first, and over a decade later, her TFSA has compounded tax-free to $220,000. Later, she uses it for a car and healthcare costs without affecting her OAS or tax bracket at all. So when it moves up the order, sometimes it makes sense to use your TFSA earlier. For example, if you're planning around GIS, so if your income is really low and you want to keep that way to qualify for this amount, you might want to draw from your TFSA first to keep that taxable income low. And if you're near the OAS clawback threshold, the TFSA withdrawals can help keep you under that limit. Basically, if you're in any scenario where you want to keep your income really low, but you also need the cash, consider withdrawing from your TFSA in that case over those other accounts. And if you want to save more on taxes in retirement, check out our free guide with 5 proven strategies to keep more of your money. Grab your free copy. The link is in the description. All right, next up in the order is what I call other income sources. These aren't as common as the first 4, but I'm starting to see a bit more of them now, which is your home equity through a HELOC or a reverse mortgage. Now, home equity to me, I think should be treated more as a last resort safety net, not a regular income source. In most cases, there are some exceptions. If you want to get a HELOC though, make sure to set it up early while you still qualify and have the income to qualify, and repay it once the markets recover. A reverse mortgage though is much more permanent and requires more careful planning. It could be useful later in life to, say, fund unexpected healthcare costs or stay in your home longer. It can free up cash flow, but comes with higher interest and fees and some other downsides. So use it very selectively. Then we have business income or corporate investments. If you own a business or hold corporate assets, withdrawals can get very complicated. Now, between eligible and non-eligible dividends, capital gains exemptions, and individual pension plans, things like timing matters more. Rental income. For rental properties, coordinate your rental income with everything else, your RSP withdrawals or capital gains to avoid tax spikes. Also, make sure to manage carefully those low rental years that you might get, or say those high expense years where you have to make a bunch of maintenance costs to your properties. You'll have to carefully manage those along with these other accounts. Then there's your defined benefit pensions and annuities. These provide stable taxable income. Again, plan your other withdrawals, especially from your RIFs or RSPs, around this base to stay within your ideal tax bracket and keep cash flow consistent. Getting the withdrawal order right could mean thousands more in your pocket and years of extra financial freedom. And if you're overwhelmed with the decision or just want an expert opinion on this, our team at Blueprint Financial can help. So visit our website to book your free discovery call today. And here's another video on the screen that I think you'll like, so go ahead and check it out now.